Welcome to the program. My name is Marty Shenkman. I'm joined by a longtime friend and colleague, Lee Slavutin, who is a brilliant insurance consultant. He can tell you more about him if he wants. And this is part of a series on collaboration. I've always felt zealously that one of the keys to effective estate planning is collaboration. We as estate planners have our fingers or have to have our fingers in so many different areas of expertise to pull everything together for an estate plan. And it's impossible for any one person to be expert in everything. So collaborating with the accountant, with the maybe the corporate attorney, if you're just an estate planner, as I am, we just had an issue with FTC counsel on Hart-Scott-Rodino filing. There's a program we're doing on that with the insurance consultant, with the wealth advisors, getting forecasts done. There's all sorts of different experts that we need to collaborate with. And really, one of the more important ones to the entire estate planning process, as I think everybody would already guess, is an insurance consultant. Lee, do you want to say any words about collaboration with the estate planning team, or because
Yeah,
then
I'll say,
I'm going to ask you questions.
yeah. Let me just say one introductory comment. I remember, Marty, many years ago, I was at an insurance industry meeting, and one of the insurance agents brought with him to the meeting the attorney that he does a lot of work with. And he asked the attorney a question, which was a very, very insightful question. He said, "What do you look for when you work with an insurance agent?" And I thought what the attorney said was very helpful. He said three things. I look for integrity, competence, and service. Now, integrity might sound obvious, but I think to really serve a client, I think an insurance agent has to be willing to disclose the negatives and the risks involved. And I think that's one of the things that the attorney really appreciates. The second quality of competence includes creativity and coming up with good ideas. And the third one, which is service, is probably the most important in the long term. That is, that the insurance agent stays around and reviews the policies with the client and the advisors regularly for many years after the sale is made, not just once or twice, but on a regular basis. So those are the three things that the attorney was looking for. I thought it was very helpful.
No, it's a great thought. Sorry, I had to run away for a sec.
No problem.
Something came unplugged, and I will blame my dog. But unlike that internet thing that went viral, I will not smack him like some guy did. So Lee, let me start with something that I think is a real problem for many people, and that's the common use of life insurance trusts. But in those life insurance trusts, and when we were preparing the sort of hypothetical or example I gave you, Jane Smith comes to me as my client. Jane has an insurance plan, as many clients do. And Jane names her cousin Ralph as the trustee. Ralph has never talked to me. He's not my client. I have no communication with Ralph, which is common. And once that trust is set up, people don't talk to me. And I even email them and write them and call them and send newsletters trying to encourage them to come in, and they often don't. The issue for Ralph is he's got a fiduciary responsibility for the assets in that trust. And if that insurance plan doesn't work out, it's really on him and he has liability for it. But worse, the family that may be depending on the coverage or planning on the coverage could get hurt too. So maybe just talk about the importance of insurance trustees reviewing policies and making sure the plan is still viable. Because if you catch it early on, it may be not so difficult to tweak it. If you catch it too late, there may be nothing left. But I think that's a real important gap in a lot of planning. And that's something where I think the collaboration of the overall team is important because if the client's not coming back to the estate planning attorney, maybe their accountant who they see every year, or the wealth advisor they see every quarter or even every month, somebody needs to say to them, listen, this insurance is a big part of your plan. When's it last been reviewed? When has the trustee followed up on it?
So there, the doing the review of the policies for the trustee. I agree with you. It's a common problem that the trustee is I don't know how often, but certainly in a significant number of cases, the trustee does not get directly involved in the review. It's mostly the client insured. So I think it's important to involve the trustee. I like to copy the trustee on my emails. So even if the trustee was not involved in the conversation when we review the policies, I will CC the trustee. Um, I'll give you three examples of why the trustee needs to be involved. I just had this week, I was looking at a client's policies and I noticed that one of the policies owned by the trust had the owner as the trust, but the beneficiary was something else. It was not the trust. And it didn't make any sense to me. Why would the owner be the insurance trust, but the beneficiary be something else? It was actually some other kind of trust, unrelated to the owner. And I emailed the lawyer, who's also the trustee. I said, "What's going on?" He said, "It's not right." So he said, "Send me the owner and beneficiary of all the policies. All the other policies were fine. This one was wrong. We're now correcting it. We're going to change the beneficiary. But if it was left untouched, when that person dies, then the money won't get paid to the trust. It gets paid to someone or something else." So first thing is beneficiary and ownership. By the way, ownership is sounds obvious. If you're dealing with a trust owned policy, the owner's the trust. Well, wait a minute. Not every insurance application gets submitted correctly. Sometimes the insurance application is submitted and the insured is named as the owner, not the trust. And if no one's checking, you'll never know. And then when the person dies, it's part of their estate. It's not owned by the trust. So it always is important to check the owner and beneficiary regularly. Number two, the financial strength of the insurance company is not static, it changes. The ratings of an insurance company change all the time. We're seeing companies today that are in financial trouble. If we had had a client with that company and we were looking at that policy on a regular basis and we saw, okay, the company just got downgraded. It's not in bankruptcy yet, just got downgraded. We should do something. But if we wait till the company gets into rehabilitation and bankruptcy, you don't have a chance. It's all over. It's too late. So the financial strength of the company has to be monitored. The third thing that has to be monitored is, and that's probably the most important problem, is the policy. Because the policies, other than term insurance, are funded with cash, and the cash value will grow, but the growth rate may not be anywhere near what was predicted. So if you don't monitor the policies, you don't know whether they're going to continue or lapse. And we were talking before, Marty, how many policies that are projected to last for the client's life, in fact, will not. And maybe 30, 40% of policies, if they're not properly managed, will lapse before the client dies. So, three things are so important when you're reviewing.
I think what you just said is so vital, and it's the heart of the whole point of this particular webinar of why all the advisors have to collaborate, and in this context with the insurance consultant. So if you're an estate planning attorney and you prepared a trust and you've helped the client formulate a plan, in many cases, insurance is a key component of the plan. If the insurance blows up, the plan's not going to work. So we as attorneys need to convince the clients that really the trustees, if it's owned in a trust, which is very common, should be reviewing the policies periodically. I think, and I can't explain it because the same client that will call their investment, their wealth advisor in every 2 weeks with a question about something has will have an insurance policy they haven't looked at in 10 or 15 years. It's a mistake. It's got to be looked at. The wealth advisors, unless they're handling the insurance, bring in the agent or the person, the expert who sold the policies, and make sure the plan's on track. Whatever financial modeling you're doing, if there's an assumption of X millions of dollars of insurance and it's not there, that could have ruinous effect on the family. And for accountants, it may be perhaps less directly involved, but I too often for insurance trusts don't see tax returns done because it's a grant or trust. Often there's no income because gifts are made each year and used to pay premiums. A number of trusts in 2020, 2021, we encourage clients to put significant money into the insurance trust to pre-fund them because we thought grant or trust status may be eliminated. And the political pendulum will swing again in Washington. Who knows what's coming down the pike? But even for accountants, I prefer the accountants to do a simple grant or trust return if there's a basis for it, because now it's on their radar screen and they know about the trust. And accountants are certainly a critical advisor for every client, and having the existence of that trust on their radar screen is very important. So I think it really behooves all of us, for the reasons that Lee just cited, to try to get those policies reviewed periodically. Lee, let me push you a little bit on periodically. Every year, every 2 years, every 3 years. How do you gauge, if I'm an attorney or an accountant or a wealth advisor, how do I gauge or estimate how often I need to pester the client to get you to review the policies and the company as well?
A minimum is once every 2 years, ideally once every year. But if you can't do it once every year, it should not go for more than 2 years without a review. That's
Okay.
my experience.
Yeah, I was thinking three, but I'm going to take you at your word. I guess with the potential risks of financial change for the carrier, you need to look at it more regularly.
Yeah, we have in the news now a PHL variable, large company in rehabilitation, and policyholders might lose significant amounts of money in their policies. And if those policyholders had been watching the company and the ratings proactively years ago, they might have gotten out.
Or at least partially out.
Yeah, right,
Yeah.
right.
Um, Anything else you want to comment on trustee responsibility liability? Because I just believe that's a potentially significant issue. Too many insurance, the trustees of too many client insurance trusts just feel they're doing a favor for the family, and they don't really treat it as a professional responsibility. And it is. They have a fiduciary obligation to carry out what the trust provides for.
I think the statement you made earlier is very important. This should be treated like any other investment. As you said, clients will not only look at their investments every week, or they'll be looking at their investments every day or every hour, or they'll be looking at the stock price. So certainly we should treat insurance that has cash value like an investment, because it can go up or down, and it can fail or it can succeed. The second thing is, Marty, state law is important. There are some states that actually prevent a trustee from delegating the responsibility to the insurance advisor. That is, the trustee still remains on the hook. Even though they may hire an insurance advisor, they can't just remove themselves, at least in some states, from the process. So state law is important. There's also uniform trust law, which specifically talks about fiduciary responsibilities, not just what we talked about with the rating of the insurance company, the performance of the policy, but things like the cost. You have a client who smoked cigarettes when he bought a policy 10 years ago, and he stopped smoking 5 years ago. Has anybody gone back and say, wow, you stopped smoking? We go back to the company, and if you have not smoked a cigarette for 12 months, we lower the premium. If there's
Oh,
no review done, he's wasting money.
I think the broader lesson of that is to monitor the facts and circumstances on the insured, on the insurance company, on the policy performance, and on the client situation. Look, and maybe this is another question we can transition to, but the tax laws change all the time. Not so long ago we had a million or $2 million exemption, and now it's 15 million. So policies that were purchased to pay an estate tax may no longer be relevant. Why don't we talk about that for a minute? So a lot of clients have survivorship insurance policies that they bought when the exemption was $1 million or $2 million, and now they're nowhere near an estate tax because of the current $15 million exemption, which may change in the future. We'll see. I don't know what the word permanent means in Washington parlance, but what can you do? And this is another reason that the insurance consultant and the insurance planning has to be kept up to date. What do you do with these old trusts? I mean, you could certainly keep it if the policy is performing well. What else might you do with a survivor? Let's just start with a survivorship policy. What else might you do with it if it's no longer believed to be necessary for estate taxes?
Well, I found over the years, as the estate tax exemption's been going up steadily for many years. When I started in the insurance business. I think the exemption was like $600,000 many, many years ago.
I'm as
Um,
old as you, Lee.
And so most clients don't get rid of their policies. Most clients will keep their policies. The only question becomes really not so much do they need the insurance for estate liquidity, because the answer is probably no if their estate has not grown as fast as the exemption. But the question is the policy performing well? Is it a good policy? Is it a good asset? So if you have for example, an old survivorship whole life policy. They paid in a lot of money 20, 30 years ago. It now could be performing really well because all the expenses are paid for, or most of them are paid for. Most of the initial commissions are paid in the first few years. The residual commissions are relatively small after 10 years. So it could be growing internally at the rate of 4 or 5%, tax deferred. Nothing wrong with that as an asset. That's a nice asset. On the other hand, you might have another policy, a universal life policy that's underfunded and might lapse, and you lose all the money you put into it. Then you have to say, what do I want to do with this policy? Do I want to keep it? Do I want to raise the premium? Do I want to consider selling the policy as a life settlement? That's always an option. If the policy is not performing well and there's no need for insurance, maybe you'd get more money from a life settlement than from surrendering the policy. So I think the first question to ask yourself is this policy a good asset to keep or not?
Even if it doesn't serve its initial purpose.
Right, right.
But that's what's important about reviewing the insurance coverage because it may be repurposed. So the initial purpose, paying an estate tax on the second death, is no longer relevant. But now Lee has given us another purpose that maybe it's just a good investment that's not correlated with the market, depending on the
Right,
policy.
right.
Um, One of the things we were chatting about, and I remembered a rate, you remembered a somewhat lower rate. It doesn't really matter because the rate is way too high. But on life insurance and trust-owned life insurance, I've seen, I've read, I've heard many times that and you could phrase this more accurately. I'll say it, but I'll probably be wrong, so you can correct me. Um, the likelihood of a policy lapsing before the insured's table mortality, when they should die by the tables, is very high. It could be 30%, 50%, whatever it is, it's a very high number, which means that the policies are either underperforming, underfunded, because too often clients want to buy a policy based on who tells them the lowest premium, not on what's going to give the best economic performance. But that's a scary thought because, again, clients may have this insurance that they're relying on, and it may not be there because a large percentage of policies are just going to lapse economically before the insured is even scheduled to die based on table life expectancy. And by the way, as I think everyone knows, there's a correlation between both education and wealth and longevity. And therefore, our clients are actually living longer, which exacerbates that problem.
When you spoke about underfunded policies or pricing of policies, it reminds me of a quote from Professor Joe Belth, who was one of the great insurance advocates. He passed away, I think, a year or two ago, but he was a wonderful advisor. He said that the most important factor when you're buying insurance is the financial strength of the company, not the price of the policy. And then I like to add, if you were buying a parachute, you would not buy a parachute based on price. You should not buy a life insurance policy based on price. It's a big, big mistake. And one of the commonest causes of lapse, as you said, it could be 30, 40, 50% of policies will lapse unless they're managed properly, is they're underfunded. People want it, they think they're saving money, and they're thinking short term, not long term. They need to think long term. The best way to fund a policy long term is to overfund it in the first 10 years. That way you build up a reserve of cash so that if performance doesn't meet expectations, you are very well positioned.
Yeah, it's interesting. That's exactly how clients view it. It's a cost. No, it's actually an investment.
And there's two other important factors that cause problems. We talked about underfunding. We talked about performance of the policies in terms of the investment. But there's two other factors. One is loans. and the other is maturity date. Very important. And again, these are not going to be discovered unless you have an insurance agent who knows what he or she is doing reviewing the policies. So, loans. People take loans out of their policies. It's probably less common with trust-owned policies, but it happens with trust-owned policies as well. They take out if it was trust-owned, the trustee would take out the loan. The problem is people take out a loan and they don't service the debt. The interest accumulates or is accrued on the loan. So before you know it, if the loan is interest rate is 7%, that loan will double in 10 years. So what was a $500,000 loan becomes $1 million loan. And eventually the client gets, or the owner of the policy gets, a notice your policy is about to lapse because the loan has exceeded the cash value. Some clients will just ignore it and throw out the notice, and they'll get a 1099 in January for taxable income because the loan exceeded the basis in the policy. It's loans are a very dangerous phenomenon if they're not managed properly in life insurance policies. The other fact that causes huge problems in management is the maturity date. Years ago, universal life policies had a maturity date of 95. That means at age 95, the policy ends. And if the client is alive, and we have clients now alive in their 90s, we even have a few people who survive beyond age 100. If they're alive at age 95, they don't get the death benefit, they get the cash value. If the policy has a $5 million death benefit and 200,000 of cash, they'll get 200,000 and the death
And
benefit's gone.
and the policy is done.
Done.
Wow.
So maturity age now, some companies have been good. Some companies give you an extension. That is, if you know about it and you notify the company, I want to extend my policy beyond age 95, they will extend it and you can keep paying premiums and maintain the death benefit. But if no one is watching it at age 95, that policy is going to end.
How common is that, Lee?
Uh, it's if you have one, it's too common. If you have
Yeah.
one client in that position and you get stuck and they died or they had the policy at 95 and all they got, you don't want to have that situation. It was actually written up, Marty, in the Wall Street Journal about 5 to 10 years ago, front page. I don't want to name the company because I might get into trouble if I name the company, but it was a very, very well publicized case. This old man had two or three policies with this insurance company, got to age, in his case, I think it was age 100 was the maturity, and had no death benefit.
Lee, let me change gears completely and posit a question to you. I may be wrong, but it seems to me to be something that comes up, especially with clients in their in 40s, 50s, 60s. I often see clients that have massive amounts of life insurance, and no disability coverage, and they're still working. Comments, thoughts?
Um, if you have a client that has a substantial income, professional clients, doctors, lawyers, dentists, architects, it's critical to have disability insurance unless they have huge amounts of liquid assets and would never have a need for disability insurance if they were unable to work. I mean, obviously, if someone has $50 million of liquid assets, they probably won't even qualify for disability insurance because the insurance company won't issue the policy if they've got that much investment income. But if they don't have that much investment income and they're earning 1 million or 500,000 a year, and if they when I unable to work in their profession or their job, it would be a disaster. So we disability insurance, and also we try to design the policy to tailor or to match the person's occupation. So it's called own occupation, meaning that if they cannot work as a lawyer, they can't be required to go out and earn money elsewhere. They will get paid the disability benefit if they're not working in their job. Also, we attach a waiver of premium rider on their life insurance so that if a person is paying 50,000 a year for whole life insurance and he has a waiver of premium rider and he becomes totally disabled before age 60, the insurance company will continue that policy as if he was paying the whole life premium, and he's not paying anything out of pocket. So
I think
waiver of premium for disability on a life insurance policy is also a valuable feature.
I'm guessing that many estate planners don't really focus on disability coverage like they do life insurance because they don't view it as part of the estate plan. If the client has a wealth advisor, that's something they'll clearly focus on because that's, planning for retirement and cash flow needs. But a lot of clients still try to do everything on their own, and don't have a wealth advisor, and it just doesn't get brought up enough. But to me, that's another reason that as an estate planner, I want the client meeting with an insurance consultant because these are questions they need to explore. What they decide to do is almost secondary to whether to their knowing about it and being informed and making an informed decision. That kind of segues into one of the things that I think is a very important insurance opportunity, and maybe that's not even the right word, but integrating insurance planning with the estate plan. For years and years and years, we estate planners have done tons of estate plans focused on non-reciprocal spousal lifetime access trusts, SLATs. And husband sets up trust for wife, wife for husband, etc. We're not going to get into the divorce issues of SLATs. That seems to often be overlooked. I know everybody focuses on the reciprocal trust doctrine, but one of the other issues besides the divorce issue that I think, and even probably more than the divorce issue, may not be addressed is some of the financial gaps. So let me talk about a typical, because I don't think we need to get complicated, and I'll set the table and let you comment and talk. So one issue, and we're going to go through long-term care, disability, and life insurance. But the obvious one is life insurance. So, and I'm going to just say husband sets up SLAT for wife and wife for husband, and assume we differentiated them enough. And how you differentiate them is important because depending who is a beneficiary to what degree, how, and when, may also influence what kind of insurance coverage you may need to fill the gap. We're not going to get that detail because I think the general picture is what we need to address. So if I set up a SLAT for my wife, if my wife dies prematurely, I can't get access to my SLAT indirectly through her because she's no longer alive. It just becomes a dynasty trust for the kids and grandkids. Had I done a SPAT, special power of appointment trust, or a DAPT or hybrid DAPT where I could be added back, it would be different. But those are not done that often. I think a lot of practitioners are concerned about the complexity. They're concerned about using situs in a different jurisdiction that permits them, and so on. What would what do we do to address properly, in your view, the mortality risk of, let's say, moving, 30, 40% of the wealth into a SLAT and then the spouse dies prematurely?
So the obvious answer is you get a life insurance policy on that on each spouse that can replace the income. Now the question is, do you want to get a term policy or a permanent policy? I guess it depends on how much investments there are elsewhere that can support the surviving spouse. But yeah, sure, you want to get a life insurance in place to cover the risk that if that spouse dies prematurely, you're cut out of that trust.
I don't think that's done nearly enough, and I think it's really important. And I think when estate planners, whether they be wealth advisors, accountants, attorneys, whoever, has clients coming back in and they're reviewing an estate plan, these gaps should be looked at. The fact that it may not have been done initially is not a reason it can't be done now. Now, I've seen wide variation as to your comment about permanent versus term. And the way I like to see it done, we had the wealth advisors, in many cases, the clients let them do some modeling. And we found that we didn't need a permanent policy because the clients had sufficient wealth in the other SLAT plus their own names that they didn't transfer, because you're not going to transfer all the assets. By no means, that's probably a fraudulent conveyance. So between their retained assets and the assets in the other spouse's non-reciprocal SLAT, we found that, based on the projections from the wealth advisors, that a term policy for 10 years was enough to get them over the hump, because then between now less life expectancy and growth in other assets, they had enough to do it. And I think the tailored answer is very important, Because if the client is not looking for other reasons to buy insurance, maybe the insurance need in terms of cost isn't that great, but the insurance benefit, if there's a premature death and they didn't do this, could be catastrophic.
Um, yes, a couple of comments on the term insurance. I don't know. My experience is that unless they really have a lot of assets elsewhere, and maybe if they're older, 10-year term is really goes very
That
quickly.
that was a couple of exceptions.
Yeah,
But
yeah.
I'm
I
saying
mean, I
it's
would
been on
normally
the
do a,
low end, it's been that. On the high end, we've bought large permanent policies.
or I would just do a longer term insurance. In other words, 20 or 30-year term
Right.
insurance. The other thing is about term insurance. I think it's so important, Marty, is to make sure you have a good conversion option. Because if things change and you want to convert that term to permanent insurance down the road for whatever reason, you can get caught. If you buy a 20-year term policy, you need to make sure that the conversion option is for the full 20 years. Some 20-year term policies give you a conversion option for the first 5 or 10 years only. That's not good. Some carriers don't give you flexibility in terms of what you can convert into. They provide a policy which is very expensive as the only conversion policy. So the conversion option is really important when you're buying term insurance.
I'm going to make a side comment, but then we'll go back to slats. When clients are diagnosed with a significant health issue, one of the first things I tell them to do before you even come to me, call your insurance agent, find out if you have any options and if you can convert whatever term coverage you have. Because once those options lapse, they're out of luck. The most common time when I find out about the conversion features is after they've lapsed because the clients don't come to me quick enough. They don't go to their insurance consultant come quick enough. And then you find a client's diagnosed with a really serious health issue and they can't continue their insurance, which is really a financial negative. Um,
I just had a client where he had a term insurance policy and it was coming to the end of the 20 year of the term. It was 20-year term. And the only way he'd continue the policy as a term insurance policy, he'd have to pay an enormous premium when you
common.
get to the end of the term. But we could convert it. So we did convert it to a universal life policy. The premium was much, much more affordable. He actually died about 6 months later, and his
Wow.
family got the death benefit. Now, if we had not done that and they dropped the term insurance, they would have had nothing.
Yeah. And that can be a huge impact on the family. Huge impact. Um, One of the issues that comes up if you're going to add insurance onto a slat plan, some slats include the provisions you need to make them into insurance trusts because a slat conceptually is not that different than the old islet. The problem becomes in some slats, let's say there's family business or real estate interest. So the client, the settlor, is named as the investment advisor or investment trustee, and then you have an independent person perhaps as trustee. You can't have the investment advisor. I wouldn't want to have the investment advisor making insurance decisions on an insurance policy on their own life because of my concern that under 2042 you have an estate inclusion issue. So it may be if there's already provided, and we kind of do this routinely now. We didn't years ago because I hadn't thought of it, include a separate insurance trustee function, even if they're not appointed, because that way we can bifurcate it from the investment trustee who may be the client. So I think we can avoid the 2042 issue with that. And a lot of times we'll leave it to the trust protector. I don't know if the law has changed. I believe the last time I asked a Delaware attorney, they said it was being looked into, but I don't think a trust protector can simply bifurcate trustee functions in a trust. You actually have to like decant it into a new trust and create that. And I think there was some issue with that under Delaware. I don't know if any state laws permit that. So unless you've provided for it in the existing slat, you may just have to set up a simple home state insurance trust to facilitate that insurance ownership. And with the higher exemption amount, it may not be an issue funding it. If annual gift exclusions don't work, you could do a split dollar loan from the slat to the islet just to help fund it, and all that money that's paid back is out of the estate as well. Any thoughts or comments on that?
Um, I do prefer or like the idea of having just a simple separate eyelet, so there's absolutely no question about 2042.
I agree. The reason I like to build it into the slats is if a client's putting 15 million, 10 million, some large number into the slat, then I don't have to worry about getting the premiums paid for. I don't have to worry about crummy powers, annual demand notices, anything, because the funding is there and they can just pay for it. But you have to be mindful of the 2042 issue. Let's change gears a little, Lee, because I think there's other important issues that come up. We've kind of talked about them, but I think it's worth just having you comment in this context. So if clients in their 40s done really well, made a lot of money on some startup company they sold, and they put 15 million into a slat, and their spouse puts, 15 million into a slat, um, but they're still working. What about long-term care coverage? 40, 50 years old. I think it's 60 years old. What about long-term care coverage? If they, before they made these transfers, they may not have felt they had any worry about long-term care. And it's not that they have a worry because they're still beneficiaries, there's still access points, you can borrow money from the trust, but it just seems that the financial dynamic in terms of evaluating long-term care coverage may have changed when they make these large gifts to trusts. What about evaluating again long-term care coverage or for the first time?
Yeah, yeah. I think that long-term care insurance, you could kind of think of it as clients fall into one of three groups. The very wealthy clients with a lot of liquid assets, like 30, 40, 50 plus million of liquid assets, they don't need to buy long-term care insurance. I mean, they could buy it as a way of not depleting their estate, but they don't need it to pay for their expenses. At the other end of the spectrum, you have clients with very modest estates and they probably can't afford to pay the premium because the premium for long-term care insurance is not cheap. It's going to be 10, 15, 20,000 per person to get per person, not for a couple, to get a proper coverage. So really it's the middle group, the group with say 5 to 30 million dollars of assets that are the best candidates for looking at long-term care insurance because it would have a significant impact on their estate if they did need long-term care. It's a very expensive proposition. It could be 100,000 a year or more in some states. And today, the market for long-term care insurance is different. The old standalone policies are almost non-existent. Very few companies today will sell a pure standalone long-term care insurance policy. The policy premiums on those policies have gone up dramatically. Even on existing policies, the premiums have gone up. So today, we're mostly selling for long-term care insurance a combination of life and long-term care insurance, sometimes called a hybrid policy, where the policy not only provides for long-term care, but also a death benefit and a cash value. And it's an interesting thing. I just had a client who 5 years ago bought a hybrid life long-term care. He was in perfect health, going to the gym every day. I mean, he was so excited about the exercise program he was on. And then 2 years ago, he develops leukemia and he died. And the family actually got a death benefit which exceeded what he had paid in premiums. So it really be the death benefit and the cash value in the hybrid life long-term care combination of those are valuable features.
Let's talk for a second about disability insurance in the context of a large gift to slats or other irrevocable trusts. And then let's take a step back and talk about the big picture of all three coverages. So if I have a client in their 40s, they're working, they're making good money, just like we talked about a few minutes ago. And now all of a sudden they shift a large chunk of their wealth into the slat. It seems that their cushion has now been reduced. They're still relying on income. Even if there's lots of ways, it could be a hybrid DAP, a SPAT, there could be loan provisions, tax reimbursement provisions, but it's still not the same as money in their pocket. So it seems to me that that's also an inflection point of creating this estate plan and this large wealth transfer to evaluate disability coverage because they may appreciate it in a different way. Any comments or thoughts on that?
It's going to, yes, it's going to depend. One big factor will be how much investment income they still have. If they've given away a large chunk of their assets into a slat and they don't directly receive any income from those assets, then the question of disability insurance can be relevant. If they still have very substantial investment income, 500,000 of investment income, they're not going to get disability insurance. So that's really a key feature.
So stepping back for a second, I think that when an estate planning team is putting together these large irrevocable trust plans, large maybe for some listeners it's not large, but large relative to the client's wealth, um, it seems to me that to some degree, whether it's small or very significant, you have disability, long-term care, and life insurance needs from all of these plans. And to me, I want the clients to consult with an insurance advisor. Whether they buy or not is up to them. But you're going to explain these issues in a different way than I, as an estate planner, are going to explain them. You're going to quantify the options for insuring against those risks. If the client feels that risk is material, they can buy the coverage. If the client feels the risk is not that material and that they can weather the storm, so to speak, they don't buy the coverage. But two things I think are accomplished by bringing the insurance consultant into the plan, hence the theme of our series of collaboration, is that first of all, the client's going to understand the financial gaps that our estate plan creates much better because they're going to see it through your lens as an insurance consultant, and you're going to dollarize what the solutions are. The second thing it does, being selfish for a moment, is the client is going to be harder pressed to come back and say to me or whoever the estate planner is, you didn't tell us about this risk. You didn't point this. No, I did. I sent you to Lee, and Lee quantified it and did a whole analysis. So I think it's educational and informative for the client because ultimately it's the client's decision what risks they want to bear or not bear, not ours. And you're giving them the information to assess that. And secondly, for our own selfish reasons, whether we're the accountant, the attorney, whatever, when we're doing an estate plan and someone presents these insurance options and quantifies the risks of premature death or disability, it's not like we didn't tell them about it. So I think it's protective of us, and it's really very importantly educational for the client so they can make an informed decision. Any thoughts or comments on that?
Yeah, the other thing I would add, Marty, which is not my domain or my area of expertise, is that it's also important to have on the team, and most people will, a really good property and casualty insurance advisor. Things like excess umbrella liability coverage, property coverage they often have valuable things, jewelry, cars, boats, etc. So a good P&C insurance advisor is a very important part of the team as well.
Very, very much so, and I'm glad you brought that up. When clients are making large wealth transfers, it may even be more important to have the insurance backstop because they don't have the wealth if there is a claim, and they don't have the assets in their name that they are going to be, the risk to them of further depleting assets after large wealth transfers, even if they can access them, it's not quite the same as having it in their own hand. Makes a world of sense. Makes a world of sense. Lee, let me ask you a crazy question just because it came up recently. What do you feel about people, about life insurance policies on minor children? Is there any reason that anybody would do that? What is the rationale for that?
Yeah, I mean, I've done it a number of times for my clients. When a client has young children or grandchildren, buying a whole life policy on a child becomes a wonderful savings vehicle for that child later in life, besides having the insurance protection. We typically will fund the policy over 10 years to get it overfunded. We intentionally want it to be overfunded so that it will really build up cash and insurance over time. And it has, as you know, life insurance has unique tax benefits. You can borrow money from a policy on a tax-free basis under current law. So it's a wonderful vehicle. I did this a year or so ago for a client for he has three children, and we got what's called a 10 pay whole life policy for each child. And they now have an insurance policy and the cash value building up. Initially, we have the parent own the policy, then later on it gets transferred to the child or a trust. But it's a very simple easy. Underwriting is easy because there's no medical exam required for a child. It's a nice product.
Would you have so you'd have the parent first own the policy, and then what, when the child is 18, transfer it to the child,
Or
and
to a
then,
trust.
but wouldn't it have to go through the child first as the insured, then to a trust?
Um, I'm not sure why.
I've not done it. I'm
Yeah, I
asking. I
mean,
don't know.
I think the owner of the policy, if it's the parent, could I guess if you want the child to be the grantor of the trust,
Yeah, I
maybe
think you
yeah,
would.
yeah, then maybe you're right. Maybe let's go through a child.
Yeah. Um, any other points that you think we should talk about? I just to reiterate one, because I think it's so important. Don't assume that the application has been done correctly and that the policy that you believe is owned by a trust is owned by the trust unless it's in fact verified. We've seen, as Lee mentioned earlier, a lot of mistakes on that. And that's why it's so important to have a proactive relationship and a collaborative relationship with the insurance consultant. Um, Lee, in overall in the theme of collaboration between all the different advisors, wealth advisor, attorney, accountant, and the insurance consultant, any other general comments or thoughts you'd like to make, or topics you feel we should discuss that we haven't?
I think we said it at the beginning. There's just no substitute for an annual review. It is such a valuable service. And actually, I'm saying it also from a selfish point of view. The annual review is a great reputation builder. When an insurance agent does an annual review for a client and he calls or emails the attorney and says, here's an updated review of the policies, you're building up a wonderful reputation for yourself as an insurance advisor, that you're not just there to make the initial sale, but you're there 5 and 10 and 20 years later to service that client. The I mean, I had you get really good feedback. I get tremendous positive feedback from advisors and clients when we do these reviews, especially when you uncover something that has to be corrected.
Lee, what kind of give me a quick checklist off the top of your head as best as you can do. What should be done in that annual, or you said biannual insurance review? You want to check the owner, you want to check the beneficiary, you want to check the company's performance, you want to check the policy's performance, you want to review the circumstances why the policy was bought and see if it still makes sense. Maybe they need more coverage, maybe they need to repurpose. What other things would go into the analysis that you would do?
Any policy loans, that's a big one. Watch out for policy loans. So I think you covered the key things: owner, beneficiary, financial strength of the insurance company, in particular, has it been downgraded? Performance of the policy, which means you have to get an updated in-force, not you, the attorney, but the insurance agent has to get an updated in-force illustration of the policy. And when you get the updated in-force illustration, which is just a reprojection of the original illustration or proposal, you need to stress test it. You know, you the we talked briefly before we started the recording about this recent case of a racing car driver, Kyle Busch, who's now suing an insurance company because he paid, I think, $10 million of premium, $10 million of premium over a period of 8 to 10 years, and the policy's lapsed in 10 years.
Wow.
You just the policy review is so important to pick up problems and prevent disasters like this one occurring.
You also mentioned checking for the maturity in case the policy has a
Yeah,
maturity.
the older universal life policies have maturity endpoints of 95 or 100. You want to check those policies well before you get to 95 so that you can correct a problem before it happens.
Any other thoughts on what would go into the annual insurance review?
Um, I think those are the main things, Marty. Yeah, I think those things we just mentioned are the key things.
Let me add to that. You want to look at the insurance trust because frequently insurance is owned by an insurance trust, and many. I'm almost inclined to say the significant majority of older trusts are ended like age 35. So if you have a child that's going to get everything outright at 35, you've lost any asset protection divorce protection on those funds, you can decant the trust and extend, in many, if not most cases, the duration of that trust. Another thing to give thought to, some of these old insurance trusts, probably a lot of them, weren't structured to be GST exempt, and GST would not have been automatically allocated, and they probably didn't file gift tax returns because they were doing crummy powers. So if you have an ILET that ends when the kids are 35, and typically when I see this, the kids are already in their 50s or 60s, decant it, make it a long-term trust as long as you're allowed under state law. But think about also doing a late allocation of GST. If you can make this trust go long term so it can go on to the grandchildren, and the client estate is modest relative to the exemption amount, use up that GST exemption with a late allocation, and now you've taken a so-so plan, you've gotten the insurance reviewed, you've gotten a long-term GST exempt trust. That's a great result. That's a
The
great
one thing we
result.
talked about before, which I forgot to mention just now, is the health of the client. So we
Oh,
talked about
very
the
important. Yeah.
example of a
Oh,
smoker
yes.
who stopped smoking, reducing the premium. By the way, not just smoking, but cholesterol. You have, we had a client a few years ago. She had high cholesterol when she bought insurance. She started taking a statin, and a year later her cholesterol went down. Went back and got a better rating.
Wow. Wow. Um, what should non-insurance consultancy, estate planning attorney, wealth advisor, accountant, what should we stress in communications with clients to hopefully motivate them to do what you've just recommended?
Just treat your insurance like an investment. You cannot ignore it because it can cause terrible long-term problems. And the beauty of doing the reviews is if you catch it early, you can correct the problem without a huge price.
Okay.
Just treat it like any other investment. You need to watch it.
I'm out of points unless you have any others.
No, that's all I can think of for now.
All right, so I want to thank Lise Levutin for joining me. Again, the premise or the objective of this sort of informal webinar series, and I've intentionally made it informal because I thought the chatting would be helpful because it's all about collaboration, and that's more about chatting than the formality of a PowerPoint or article. Um, and I think we all do a better job. I think we're all safer from missing something when we collaborate with all the allied professions in what we do. We much more important to collaborate and get a good result than it is to be the big cheese on any estate plan. So thank you, Lee, and thank you all for
Thank you.
joining, and take care.